Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. As we wrap up the first month of the new year, it's time to look ahead with our 2021 predictions panel. You're going to hear from lots of smart folks to find out what they're looking towards in 2021. Today on the Real Estate Guys radio program.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Welcome to the Real Estate Guys radio program. Thanks for tuning into the show. It is pretty quick out of the gate with the new year. We're still in January, and we're going to do something that we do every year around this time, and that is it's our annual predictions panel. First, let's say hello to our co-host and financial strategist, Russell Gray.
Hey, Robert.
You know, Russ, this is a great chance for you and I to pick the brains of some pretty smart folks and find out what they're looking towards in 2021.
Yeah, absolutely. I mean, I think my favorite thing about being the co-host of the show is all the big brain people we get a chance to meet and talk to who will take our calls. And every time we ask them questions, we always throw on the microphones. But if you think about your real estate investing, obviously there's a macro picture. We care about interest rates. We care about the value of the currency. We care about policies that affect jobs. There's a whole lot of policy change going on right now, especially in the energy sector, which has been a big job creator. Obviously, COVID-19 and the fallout of that has people moving and businesses moving and things happening that are kind of part of the new normal. So there's a lot of things to sort out since we did our COVID-19 crisis investing series at the beginning of 2020, and really interested to hear what these big brain folks have to say about what they foresee in 2021.
We have a variety of guests today from different walks of economic life, and it's going to be rapid fire, but you're going to dig it. When we come back, our 2021 predictions panel on the Real Estate Guys radio program.
Hi, I'm Mark Victor Hans. You're listening to the Real Estate Guys. If you want to expand your consciousness, expand your wealth, expand your future, and have more delight and excite in your future than in your past, keep listening to the Real Estate Guys.
Well, welcome everybody. I'm Robert Helms, the Real Estate Guys radio program. It is practically a brand new year upon us, and one of the things we do in the first month of the new year is ask the smartest people we know, what are they paying attention to? What are they looking at? What are they looking for down the road? Because change happens gradually, and sometimes change happens all at once. Let's say hello to someone who keeps their eyes on the economy, the financial markets, and even real estate. From Quill Intelligence, it's our friend Danielle DiMartino Booth. Hey, Danielle.
How are you? Happy New Year.
Well, Happy New Year to you. Always great to see your smiling face. And you pay attention to a lot that's going on, and there is a lot that's going on. I guess the big picture is we can put the presidential election in the United States behind us, and we can see where some things are going, but it's still not crystal clear. What are you looking at right now?
Well, I think that the market, I think on Inauguration Day, the market was like, woohoo, we're going from 600 to 2,000 per person. And we're doing it, initially, I think Chuck Schumer had said money in the hands before the end of January.
Right.
And boy, it sounded really good at the time. I mean, it really did. And when you consider that so many of the recipients either added money to savings or put money into the stock market, it was a pretty exciting prospect. And yet here we are now talking about hopefully by the middle of March, in parentheses, that is when those extra unemployment benefits run out. So it had better be by the middle of March. So we're back to a waiting game. It seems like the more things change, the more they stay the same.
Yeah, isn't it true? Now, let's talk about real estate a bit. I know you keep your eye out on this. In fact, you've been monitoring some recent moves, transaction, things that are happening in marketplaces. What are you looking at in real estate that might give some insight to our listeners?
So real estate is as bifurcated as it's ever been. It's not about location, location, location. It's about whether you're in the urban center or in the exurb. And there's really not much in between right now. So, 2020 was an interesting year. You have seen and you continue to see rents falling in these big metro areas. Fresh data out of TREP shows that in the month of December, we saw multifamily delinquencies pop from like 4.9% up to 16 and change percent. So we're definitely seeing the lagged effects of multifamily urban centers start to show real stress. And yet you see an announcement from InvestCorp that they're plunking several $100 million into apartments in the suburbs of Atlanta, the suburbs of Jacksonville, Florida. They're effectively following the people out of the cities, and you're going to end up having a greater demand for type B properties, let's say, in some of these suburban markets where you have indeed seen rental price appreciation very steadfast, not under any pressure vis-a-vis those big city centers. So it's going to be a matter of, where office and multifamily is weak and where it is not.
Danielle, you were part of our crisis webinar series that we recorded kind of midway through 2020. And one of the things you were pointing to were these big moves in real estate. The fact that people were leaving New York City, people were leaving higher income markets. And then now we see that the eviction moratoriums have been extended, pretty tough for landlords and lenders. And that's going to have something to do with performance and maybe even availability of properties. But the other thing is you have people that are making life decisions now based on their changing roles. A lot of people that used to have to get up and go to an office, for example, are not doing that because they can do their work from home. How do you see that impacting specifically real estate going forward?
So, a word that is being thrown around by macroeconomists right now is scarring. And I think that we're going the same way we're going to see scarring in the labor force, I think, and more permanent unemployment than any of us are expecting in the aftermath of a pandemic. It's not going to be that reopening is not going to bring everybody back into the workforce. That's a fallacy. But we're also going to see scarring in the real estate sector. And I think what's important to appreciate is where the construction and development had been in the prior decade leading up to this. People don't appreciate that 1 in 10 employees worldwide was working in travel and tourism. 50% of hotel-backed, commercial mortgage-backed securities, this is one of my favorite statistics, are backed by luxury hotels. So there's a lot of stress that is yet to be realized. And in large part, it is because of the changing roles. You may be a consultant with Bain or McKinsey or Deloitte, and you might have been a road warrior in your past life. 12 months later, they're discovering that they're able to get the same amount per hour from the client, but have a lot more go straight to the bottom line because they're not flying their employee out on a business class airfare. They're not parking him or her at the Four Seasons or the Ritz-Carlton for 4 nights a week. They're saving a lot of money, but the ripple effects through to especially higher end office properties, higher end multifamily, and higher end hotels. This is going to take a generation to work itself out. This is not going to be something that heals itself quickly, because once corporations realize fatter profit margins, it's going to be difficult to get them to change their ways just so that road warriors can go back to having road warrior lifestyles.
Excellent points. Hey, let's talk about the fuel that real estate investors use. Of course, leverage and the ability to borrow money to buy apartment buildings and commercial buildings and even single family homes. What are you seeing there? Maybe interest rates and how big lenders are responding.
So, I think that there is something of a tug of war right now because we know that interest rates, we know that the 30-year fixed mortgage, for example, on the residential side is at a record low level. And yet you're starting to see home builder optimism roll over. And I don't know that we were expecting to see that at this juncture. And then you look at home prices and then you look at lumber prices. And you have to realize that there's more to the profit math than there is simply the ability via lower or record low mortgage rates to get into a property. And you also haven't seen with small and mid-sized banks the end of the story of commercial real estate loan write-offs. So there's going to be a reticence on the part of certain banks. Small and mid-sized banks are much more exposed than they were heading into 2020 than they were in 2007, 2008. The flip side of that is the largest banks have half the exposure commercial real estate loan exposure that they had going into the crisis. They're much better positioned to finance well thought out, a lot of distressed property, a lot of distressed deals going forward, because they're not sitting on these loan losses that have yet to be realized on the real estate side.
Well, we love the fact that you pay attention to all kinds of things, but you have real estate thrown in there. So we could go on forever and pick your big brain. But for the nature of today's show, just wanted to check in and get your feelings about real estate, what you're watching. And as always, you don't let us down. Thank you so much, Danielle.
Thank you. Take care.
There's Danielle DiMartino Booth. She's the author of Fed Up, Why the Federal Reserve is Bad for America. And she spent 9 years there. She ought to know. If you haven't picked up that amazing book, here's your invitation to do that. You're tuned to the Real Estate Guys radio program. When we come back, I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Hear ye, hear ye. Registration is now open for the Real Estate Guys 19th Annual Investor Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year, our sales legend Tom Hopkins, the editor of the Gold newsletter Brian London, international real estate developer Beth Clifford, and Jim Rohn's 18-year business partner Kyle Wilson. And joining us live and in person for his 9th Investor Summit, Peter Schiff. Plus, returning for his 9th Investor Summit, best-selling author and the Rich Dad advisor for real estate, Ken McElroy. Plus, lots more to be announced. It all begins June 11th in beautiful Belize. Visit realestateguysradio.com and click the tab that says Summit to reserve your spot. This transformational week is like no conference you've ever attended. Go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys, Peter Schiff, Ken McElroy, and an all-star faculty on the 19th Annual Investor Summit. For thousands of years of human history, silver has been recognized as money. Then in 1965, the United States took silver out of the financial system. But did silver stop being money? Smart investors don't think so. And ever since,